Have you ever wondered how you would handle the stock market or anything during a downturn, like a bear market? Watching your portfolio, your account size just decline in value, that can be pretty scary. But when you have the right strategies, you get to handle these downturns a little bit easier and even find some opportunities. And that's what we're going to talk about in this video. So a downtrend or a bear market, this is just a sustained period of declining prices. And it's typically marked by a series of lower highs and lower lows on the charts. Now, these are generally driven by negative sentiment and just weak fundamentals. When the average bear market historically sees a 30% drop over 13 months, when it happens, the key is to keep your long-term perspective. And one of the most important things during that downtrend is just to avoid making emotional short-term decisions. Remember, these bear markets, they're just temporary. And historically, the market has always recovered and gone on to reach new highs. Now, the durations that are cited, these last for about 4 months to 2 years on average for cyclical bears. This is according to Goldman Sachs. So focus on your long-term investment goals and the fundamental reasons that you're choosing these investments in the first place. Now, ensuring your portfolio is well-diversified across different assets and different sectors and strategies. This is important to manage your risk. So you want to avoid being overly concentrated in one area. Think of the dot-com bubble. Consider a mix of stocks, bonds, even real estate, alternative investments like cryptos within the portion of your investment. Just diversify across sectors and company sizes when you're talking about your stock portions. You can complement those riskier growth stocks that you hold with more defensive dividend payers. You can use different strategies like value and momentum investing. And all of that is going to provide you with further diversification benefit. And as the conditions evolve, periodically, you're going to rebalance your portfolio back to the target allocations. And this is going to allow you to take profits on the relative winners and just redeploy that capital to the undervalued assets. Now, in a bear market, you want to consider gravitating toward high-quality companies that have strong fundamentals. You want to look for businesses with steady growth, robust balance sheets. These companies are a heck of a lot more resilient, and these are likely to rebound pretty strong. Think about Procter & Gamble, CVS Health, Walmart. Also, a downtrend can be an opportune time to find value and buy really great companies at cheaper prices. So you want to hunt for stocks that are below their intrinsic value based on metrics like price to earnings, price to book, dividend yields, buying quality at a discount. This sets the stage for long-term returns. So rather than trying to time the exact bottom when to buy, consider DCA, dollar cost averaging, to gradually introduce your capital to your investments over time. When you invest a fixed amount at regular intervals, you take the emotion out of the equation. This dollar cost averaging is going to allow you to buy more shares when prices are low and fewer shares when the prices are high. And this is not guaranteed to produce profits at all, but it's a systematic approach. It's going to potentially lower your average cost basis and set you up pretty good for the eventual market recovery. And at the end of the day, you got to study and learn from those unique circumstances of the past bear markets. Analyze the economic conditions, the investor psychology, and the historical data just to gain some insight. So, for example, the Great Depression in 29 and the Great Recession in 08, these had very different catalysts, different depths, and different recovery trajectories. So you can understand these nuances. This is going to help you be better prepared to handle these future downturns. Mastering these downturns does require maintaining a long-term perspective. A lot of people have a problem with that. You have to ensure that you're diversified properly, that you're targeting quality companies with stocks. Use dollar cost averaging and just learn from history and even consider hedging. Downturns are inevitable, okay? They don't have to be devastating, though. When you use strategies that are proven to be good, you get to minimize losses. You get to capitalize on trading opportunities, and you're going to emerge stronger on the other side when the market does bounce back. So stay disciplined, focus on what you can control, and always keep your eye on that long-term horizon.